So we're recording. Sweet. So tonight what we're going to do is we're going to start with a little training on the owner finance process. So I put together a quick overview on the cycle. Honestly, what I did was, if y'all are familiar with the private lending cycle, I took that slide, modified it, because I haven't done this like this in this format or fashion before. But what we're going to do, because Paul's working on an owner finance deal as we speak. I believe that Duvon has some interest in this. Joe's expressed interest. In my opinion, like, this needs to be, for any single family real estate investor, this needs to be a tool in your tool belt. And then, so because Paul's going through a deal right now, so we want to make sure that nothing slips through the cracks on that. And then for you guys, when you have upcoming deals, it's going to be helpful. Always, I'm going to be here to help you when you get on a specific deal. But it's good to have the overview, because whenever you get into a deal, they're going to start asking you questions, meaning either the borrower, if you're dealing directly with the borrower, an agent, maybe you have a bird dog, like we have a bird dog that brings us people. So we got to be able to explain the process and answer those questions when they hop up. Because if you lose their confidence, like, they'll go look somewhere else. And I have found that to be true, right? Like, there's a pretty good little trust factor on an owner finance transaction, much like if you're doing any creative purchases from a seller, like you're buying with subject to, perhaps you're doing an novation type of deal. It's all about trust. Okay. And one of the ways, not the only way, but one of the ways that we earn trust is by being educated, being able to answer people's questions. Because when they have questions, when they have concerns, we need to be able to answer them, and that engenders trust. We are looked upon in these situations, these scenarios, as the expert. We're the real estate investor. We're the one buying real estate. Right. So we need to be able to answer these questions at best of our ability. All right. So let's go into the owner finance process. What do you see on your screen?
Owner finance process.
Boom. I was hoping you'd say that. And I'm going to create some energy. Oh, everybody in a good space? We need to do some breathing exercises. Everybody good? It's Monday. Let's do this for you. You're about to learn things. You're about to learn things that can change the trajectory of your business, which changes the trajectory of your life. This is something, like, I don't want to just like get into this. Let's get some energy up. So what we are going to do is go through the owner finance process. How does this start? The buyer, the borrower, the person who's buying the home, we're going to call them borrower right now. They find a home. Let's start with that. Let's just, review this training. Like, think it's one of your homes. It's a flip property that you have, or just some property that you're trying to sell, and you're open to the idea of selling with owner finance. Okay. So I always say on most homes, you can open up your listing. For example, if you're listing it on the MLS or your agent's listing it for you, you can put on the listing that you'll accept an owner finance, offer. There's lots of options you have for that on the MLS. You can take conventional, of course, FHA, VA, USDA. There's all these different loan programs, and owner financing is one of them. Just because you put that you will receive those offers doesn't mean you need to accept those offers. So in the beginning, when you're getting to learn this, it's good to just see what's out there. That's kind of not how I found out about owner financing. I found out about it from, went to meet a couple of my contractors at a make ready that one of my tenants, I'll say, slightly trashed. I had to spend a lot more money on it to get it ready than I wanted to spend on it. I'll put it that way, much quicker than I wanted to. And I was about like done with tenants. And one of my contractors, a painting contractor, said, I made some kind of statement. I was like, man, I just want to get rid of this house. And he's like, I'll buy it. And I was like, do you have any money? He's like, not really. And I'm like, well, we'll figure it out. And I found an attorney. He come up with a few $1,000s. This was 12, 13 years ago. I don't even know now. And the rest, as they say, is history. He bought that home. I sold it to him, and he owns it to this day, and he has not refinanced, paid the home off. He just found it through word of mouth. Most of our owner finance buyers find our properties from the MLS because we will select owner financing. And one of the other offers, this is where I said, hey, at least be open to explore the offer. On the second or third deal that I've owner finance was not something that we selected to be available for owner financing, but it was it wasn't a higher end flip, I'd say. Well, for the time it was selling for about $350,000. You backtrack about 12 years ago, and that was much higher than the median price point of our market. Because you guys know, I like to invest typically in median price housing and below. Median price housing and below is one of our principles of flipping. There's a few exceptions to the rule, but that's how we flip. And this property was in a market where median price housing was probably about $250, maybe even less, and it wasn't selling. And an agent called and said, hey, I've got an owner finance borrower. Would you be interested in selling that home with owner financing? And I said, no, I don't think so. And she said, well, that's too bad, because my borrower is, willing to put like $100,000 down. I'm like, let's talk. And we ended up selling to them. So in terms of the borrower finding the home, MLS is typically where it comes from. Socials, you can post. There's on different social media platforms, the Facebook Marketplace being the primary one. But there's groups, there's forums, things like that for owner finance buyers, where they look to find homes and sellers post homes, Craigslist, all that kind of stuff. And then we have a couple of bird dogs, so to speak, that they go put things out on social, they go put things out on Craigslist and bring a buyer to us. So there's a lot of different ways that the borrower finds a home. All that matters for this training is they found a home and they're interested in buying it. And so you guys need to figure out if y'all can work a deal. So at that point in time, the buyer / borrower, whatever, and the seller, you guys are going to meet, discuss the deal rates and terms. What does that look like? We keep myself, my agent, my TC, we have a snapshot. I can send that to y'all if y'all remind me, send me an email or whatever, a text. And we have our general guidelines. Okay. These are our general guidelines. So this is where a conversation starts. So I'm going to read them off to you. Okay. So I have them saved on my notes on my phone, and it just says typical owner financing details. So if someone reaches out, could be an agent, could be a buyer, what have you, and they say, hey, I'm interested in owner finance your home, or I have a buyer who's interested in it. What are the rates and terms? So I just copy and paste this whole little section. It says typical owner financing terms, and it says 10% down. It says 8.5 to 10.99% interest rate, 1 to 2% origination fee, 15 to 30-year loan amortization options. It says escrows required, taxes, insurance, HOA, escrow. We use a third-party note servicing company. It's $45 per month. And the RMLO / Dodd-Frank process is required, and there's a fee for that. And then it ends by saying terms are negotiable depending on buyer and other factors. Now, if this is a property that we are having a difficult time selling, I may lower the interest rate and say, hey, we're open to this. If it's one that we are not having a hard time, like we just listed it, or it's something I feel really bullish about, I'm not going to put that 8% to 10.99. I'm going to put like 10.99 or something like that. Okay, it just depends. But those are our typical owner finance details. So we send that to them to take a look, see if they have any questions. And if they're okay with, the general overview of what those rates and terms look like, then we'll kind of keep the conversation going. There may be something that they negotiate one or two things. If so, we'll see if we can still make it work. And if not, then we won't. But if we do, at some point in time, we're going to shake hands, metaphorically speaking, and say, hey, let's move forward. This may be us, my agent dealing with their agent. If you're just a seller, you're not an agent, you're dealing direct with the borrower, what have you, it just depends. But you guys are going to agree on terms. So whenever you agree on terms, number one, we use the owner finance calculator. So this is in all of your, in the members area. So I'll just hop on that real quick. I'm not going to go too in detail, but it's a basic little calculator. I'm not going to go on any examples because I don't want to share people's personal information. Oh yeah, I can. It's not showing the personal info. So we've got property and we give them a few options. I think my assistant cuts out screenshots and sends it to them individually, but it basically just projects, hey, if that's the purchase price, that's the interest rate, that's the financing length, that's your down payment. Here's estimated taxes, insurance, HOA, here's loan origination fees, yada, yada, yada. So we say, hey, we think your total estimated payment is going to be this. Okay. And so if you see this, one of the benefits of selling with owner financing is if you look here and you see the purchase price was $139 and they put down $13,500, but their loan balance is $137,000. Okay, why is that? It's not that they're being taken advantage of. We are getting a loan origination fee. Okay, and this particular one is 2 points, but their down payment, unless you require otherwise, we do allow them to put down, say for example, a minimum of 10%. But we don't require them to also cover closing costs. We want to see skin in the game. So this is a 10% roughly skin in the game kind of deal. But what we do is we're setting, paying for their insurance up front. Okay, so they're going to pay for a year's worth of insurance up front, and then they're going to start escrowing. Okay, they're going to, any taxes we owe obviously at closing, but then we're going to start escrowing immediately. We're going to actually put some money in that account, okay, at closing. So we're padding their escrow and then getting them on a monthly escrow plan, if that makes sense. They're also paying the RMLO. That's their fee, not ours, et cetera, et cetera. Other closing costs, we always highball that. Like super highball it, but they pay a portion of the buyer's agent fees and things like that if it's one of our bird dogs. So this is a quick thing. I don't want to go into details, but that's what that's about. Then the next thing is if they're good with that and they say, okay, we've seen 15, 20, 30-year options, whatever, we want 25. Okay, great. So then we move to our loan doc sheet, which you guys have seen before. This I'm not going to share because it's personal information. It's just a template. But we input all this information without going into too much detail that the attorney needs to know. Okay, because we're going to package this up, this form, send it to the attorney so he can start working on the loan documents. Pretty easy, copy and paste. We went into this last week at last week's call, I believe. Okay, so here we go. So owner finance calculator, giving them projections so they can look at 15, 20, 25, 30 years, whatever it is. And they say, I think I like that. All right, sign that. We'll start moving to the loan document sheet. So basically it's helping us cement our deal in terms of the rates and terms, things that the attorney and the title company needs to go so we can push this down the road. This is, I put this together fairly quickly. I'm not gonna lie. There would also be a contract in here. I forgot that we actually need a contract. Okay, so imagine it says sign a contract. So sign a contract, and on that contract, if you have a couple of options here. If you're an agent, use a track contract. It's always best to use so everyone here is in Texas on this call. So just use a track contract. You don't have to. Like you don't have to, you can use whatever kind of contract you want to use, to be honest, as long as the title company is going to receive it. And if you have a broker above you, if they receive it, but use a truck contract. It's the cleanest, easiest, simplest thing to do, safest thing for everybody. Just use a truck contract. So after that point in time, like we're focused on the financing here. That's why I forgot to just include the contract. But once you get those details hammered out with the, I'm going to take a step back, the owner finance calculator and the loan doc sheet, then almost simultaneously, you want to get them going with their RMLO process. Okay. Some people might want them to start the RMLO process even before, and that would be fine. So what is an RMLO? Residential Mortgage Loan Originator. So this is part of the Dodd-Frank stuff that came down years ago, where we need to make sure from a third party company, making sure that this borrower is able to afford the loan. I don't know why it's not doing a full screen here. They're able to afford the home that they're getting put in, that we're not doing predatory lending type of stuff. Okay. And we're not going to do that. So how are we going to assure them that we're going to run them through an RMLO? An RMLO is going to look at all their financials and make sure that they can afford the home. Okay. So that's what that's about. After they get approved, then we can really start moving forward to closing. I don't know why that's not doing a full screen. What is wrong with you? Okay. So everybody with me so far? Yes, yes, yes. Okay. So then you send the information to the attorney and the title company, essentially at that point saying, hey, here's the loan. I'm selling this property to this borrower. Here's the rate. Here's the term. Here's the amortization schedule. Here's points if I'm charging points. Dot. You get all that to the attorney. Just like if you're buying a flip property with a private lender, you're now working as the lender in the transaction. You're going to go to closing unless, and I didn't point this out, is because this is where was going to fit everything on here if I tried, but this is where there's some nuances when you sell with owner financing, and this is where we could get in the weeds pretty quickly. I'm going to try not to, but a lot of investors, what they used to do, and some still do, is they would do a wrap mortgage, meaning they would wrap the existing mortgage that they have on their property. So what does that mean? Like, let's say, for example, they have a property that, they borrowed $100,000 from their lender on, and they're selling it for $130,000 to the borrower. They would wrap the mortgage. The $100,000 would stay in place. That deed and all that kind of stuff. It's not recollateralized. The structure has not changed. You wrap and put another mortgage over that. Can you do that legally? Maybe. It depends on what state you're in. It depends if your broker will allow you to do it, things like that. Wraps used to be the way to go. Everyone did wraps, and we did wraps until legislation started coming down. So some states are outlawing them, and I get it. Like, they're making them illegal. And my broker, EXP, as you guys know, said, no, we're not going to allow wraps anymore. Why aren't they? And I was frustrated at first. But why? Well, this has happened a lot, where an investor will sell a house on a wrap mortgage, default on their loan, and this owner finance borrower is continually making payments, taking care of the home, paying their taxes, whatever you, and they ultimately lose the home to foreclosure. Very, very sad situation. I'm usually not pro legislation, more laws and all that kind of stuff. But this is one I agree with wholeheartedly. I get it. So when we were faced with that situation, we started figuring out, okay, we weren't just going to quit and give up. And that's what happens a lot. You'll see when market cycles change and shift, a lot of reason reasons people don't stay in business is they don't take a problem or an obstacle or a hurdle or a challenge or whatever you want to call it and just see it as an opportunity. Okay, that like things aren't working that way. Let me figure out how to do things differently. This is business, guys. Like things are always going to continually change. And sometimes it really sucks because you'll get really good at something and you're like, this is really working well. And your bank accounts are filling up and you feel good, like you're golden, everything's great. And then it changes, oh bleep. And then people, rather than going back and think about how did I create that success with this, with this strategy, with this business, what have you, like they got focused, they got clear, they took action, and they found out what was working wasn't not what was not working, and they implemented. And that's how they created that success. But boom, something will happen and knock them off track. Like they just quit. Rather than like, man, you've already been successful. You just need to do that again, but you just got to refocus on a different or slightly different strategy. And a lot of people don't do that. And so whenever I got knocked, a little sideways a little bit, I'm like, okay, what am I going to do? And so I went to my attorney. This is like, it's who before the how. Dan Sullivan would say who, not how. Who before the how. So rather than me just saying like, how can we do this? I said, who do I ask that question to? Okay, that's the key. I went to my attorney and the who, and I said, how can we still do this? Like, what is the structure? What is the strategy we can do this? So we found that out. Collateral structure of notes. So we re-collateralized my lender's debt if I had it on the property and said, hey, Mr. and Mrs. Lender, are you okay if we change the structure, okay, the collateral structure of your loan, meaning from the property itself backed by like a deed and a note, rather than that being the security, that direct property, I'm selling it now for an even higher amount than I borrowed from you. But I want to see if you'd be willing to release that lien simultaneously. We've got a way to do it safely to where your structure, your collateral now becomes this owner finance note. Took some time with my attorney. We shot a video that explained it to my lenders, and very rarely do my lenders not want to do this. There's actually additional security for them in a structure like this than there is with just a straight loaning to an investor. So that's some nuances in there. I don't want to go too thick in the weeds, but if you've got some underlying debt, then I can help you with that. Like figure out, hey, you can do this, you can do this. There's some options there. Paul, I know you're going to chime in a minute. We'll talk about yours and we can work through that. But once you get the financing situated, you go to closing. There's typically not project renovations and draw inspections like, with your typical loan on a hard money loan or a loan that you're borrowing on. But then after this, we go to fulfillment. Okay. Monthly payments and servicing. We, with our owner finance borrowers, use a third-party escrow company. What does that mean? That means after we close, the borrower's not sending us their monthly payments. Okay, they send them to another company, which the borrower pays for. And I'm not trying to like feed them to death and all this kind of stuff, but it's absolutely required. So they're sending in monthly payment, which is PITI, principal, interest, taxes, and insurance, to that company. And so we get a monthly ACH, and that's not why we do it, which is really nice. We don't have to worry about collecting payments or anything like that, that's nice. But you're going in some gray waters here if you're going to do this yourself. You can, but now you're fully responsible for setting up separate accounts for the borrower's escrows. If you're going to require escrows, which absolutely would, now that's not your money. Okay. Even if they're paying it towards the home, it's not your money, it's escrow money. Okay. So there's some complexities there. Now you got to make sure accounting's on to the cent, if there's late fees, HOA dues, all this kind of stuff. I'm not going to say it's super complex accounting, but it's we prefer to keep that arm's length distance apart from them. We have a loan that actually is just paying off right now. And my assistant's like, I think they owe us $600 more. And so we're going to get that $600 to work with the escrow companies. I think the escrow companies will off. They're not perfect either, but we always use an escrow company, long story short. And this is another reason, guys, another reason we use a third party escrow company, unless you're doing serious volume. I'm like, I don't even know what that number is, but this is, in the world of single family investing, this is about as passive as it gets if you do it the right way. Okay. The third party escrow company absolutely helps you do it the right way. If you don't use a third party escrow company, now you're increasing all your administrative work, your financing work, your billing work, all that kind of stuff. And it could be a little bit of a sketchy area that you put yourself in that I wouldn't recommend you to be in. Okay. Because now let's say that they disagree, the borrower disagrees with you on what the escrow should be, or their payments, or late fees, all that kind of stuff. Now it's on your burden of proof to prove them wrong. So you better be like really dialed in with your financials. And who wants to deal with all that? Like we're trying to create wealth here and a lifestyle that's worth living. That's why I started selling rentals or just converting rentals to owner finance notes, because rentals is no kind of lifestyle. I don't care if you have a property manager. For me, this was like the people that I enjoyed working with. They've got skin in the game. We're not getting all these calls for toilets and roof leaks and all this kind of stuff. They take care of their own property. And this is why I've got not quite 100 notes yet, but we've got a lot of notes. Like we're getting close to having 100 notes here in the next maybe year or two. We'll have over 100 notes. And most of these people I never meet, I never talk to, but I get a payment each and every month. Okay. And if they don't move forward, and I know this isn't like really a call on selling you on the benefits of owner financing, but if we do have to take one back, like we're usually happy to do so. Okay. Because there's substantial amount of equity and we can go repeat the process, but set it up for you to win. Okay. To make it a passive investment. So that's critical, because the more passivity that you have, the more passivity that you have in your business, you most likely you'll have the energy and the encouragement and desire to go do more of it. But if you're burned out, tongue's hanging out, and you're barely getting across the finish line doing whatever your other stuff you're doing, you're not going to do more. So every time we do an owner finance deal, it invigorates me. Every time we're doing rental properties in the past, I'm like, oh gosh, when are they going to start calling? This is a whole different thing. So after that, now you're just in fulfillment. You're getting these ACHs each and every month. You can log in to this third-party escrow company. Hey, here's taxes, here's insurance, here's escrows, all this kind of stuff. And at some point in time, the borrower is either going to sell the property, they're going to refinance the property, or they're not. They're just going to continue to pay. I mean, there's a chance they could default also. That is a chance, but percentage wise, this is what they're going to do. Most of them will just pay. My experience, I should say, my experience has been very few have ever refinanced or paid off a loan. A few have, like a small few. Most of them just pay, like they just pay every month. At that point in time, I threw this in at the end, and this is something we talked about, Paul and I talked about last week on the call, was explore options to sell or borrow against the note, not borrower, borrow against the note. And so what I mean by that, one, I will tell you that I've never sold a note. I've got close a couple times where I needed some cash. I'm like, well, I could sell a note, but I have borrowed against my notes. And what do I mean by that? So I not only borrow, but I changed my lender. Now I call them a collateral lender. They've loaned against this note. And typically this is a private lender. Okay. So let's go back to the example where I borrow $100,000 from my lender. I flip a home. I find a buyer who's going to buy it for $130,000. So now I'm owner financing that property to them for $130,000. I restructure my loan with my lender, so I keep their $100,000 working, so I don't have to come up with that money. And I've got a note for 130, which is an asset, and I've got debt, which is liability for 100,000. Hopefully that makes sense. Well, this 100,000 is most likely from one of my private lenders, and it's probably for a short period of time. It's probably like 2 to 5 years or something like that, short period of time. So I've got a little bit of a predicament where if I have long-term financing with my owner finance note, short-term here, I need to fix that. And most likely I want to try to get a lower interest rate. So there are banks and there are institutions, not a lot, but they are out there. Well, they will loan to you long-term money based on the collateral of that note. So I have one of those relationships set up where I can go to them, get 20, sometimes a 25-year fully amortized loan. Not great interest rates, but usually a little bit lower than my private lender. And I will pay that private lender off with this new debt, but it's long-term, fully amortized. So I don't have to worry about interest rates doing this, because that's something we have to worry about selling owner finance. If we sell it owner finance at 7.5% interest rate today, like Paul's deal, we got to think about, okay, is that okay to do? Because what if interest rates, skyrocket, and, I'm going to feel cheated and I'm just not getting a good return on my investment at 7.5% if the market starts yielding 12%. So we can do ARMs, we can do adjustable rate mortgages and things like that. And that's something to definitely consider. But at some point in time, that loan will pay off and just do the same thing over again. This is like the great thing with owner financing, is that a lot of people, I think they don't realize it, is that it's a leverage game. Like, you can use leverage. It takes a higher skill set to play the leverage game with owner financing, I would say. A little more so than, like, say, single family rental property is very easy. But that's a good thing, because anytime there's a higher level skill set that's required, it does what? It means that there's less competition. It weeds out some of our competitors. That's another reason that we're always looking for blue ocean opportunities versus red ocean. What's a blue ocean opportunity? Well, there's no sharks. There's less competition. Like, the water's just fine, versus the red ocean, which has been the real estate market for several years. Single family real estate market has been a red ocean. There's a bunch of sharks, blood in the waters, people everywhere. There's an exorbitant amount of people fighting over a limited number of deals, and it sucks. So that, my friends, is the owner finance process overview. If y'all want a comprehensive checklist, let me know. Put this on here. My TC put this together, or not, she didn't put it together. This is what we use. I can share this with y'all. I don't know if this is in the members area, but anytime we're doing a sell template, she has our standard items that we do to sell a property. Okay. To sell a property, so I'll turn on utilities, like confirm that utilities are turned on if they're not on. Like, for example, we don't always turn on the gas. But she's got all these items here, and then she has all of these for owner finance. So these are things that we do specifically for owner finance, in addition to our standard transactions. You can see on here, she's got collateral lender. If we're selling with the collateral lender, which we do quite frequently, she's got some examples on there. So if you guys want to copy this, let me know. I can send that to you. And that is the owner finance process. All right. So I suspect there's going to be some questions, especially from Paul. Or maybe I just did a brilliant job, like, I don't have any questions.
No, so yeah. Would you be able to share that slide one more time?
Yeah. Let me pull it up here. Okay, there you go.
So yeah, so first of all, that helps out a lot as far as the stages.
Mm-hmm.
But since in my situation, it's going to be my first time going through the cycle,
Mm-hmm.
going through every stage let's say for on the with using the owner finance calculator, the loan doc sheet, and RMLO process. And I watched a lot of videos on the RMLO, so I learned a lot about that, which that was really helpful when we talked about it last week. But so going through that, is that something that as I'm going through that phase, I could share for review?
Say it again. As you're going through what the RMLO process?
No, like say for example the loan doc sheet. I'll fill that out, but
Mhm.
I just need somebody to double check my work.
Yeah, of course. Just shoot it to us.
Okay, and then as far as the RMLO, is there somebody that or a company that or an organization, somebody that you recommend, or is that something you could do? Or how
Well,
does
you have to use a company for that.
right can you refer somebody
Yeah,
or
I think it's Texas Pride is who we use. We've used a couple different. I think it's Texas Pride. Let me check. I'm yeah, TexasPrideLending.com, and Texas Pride Lending. There's another company I don't know why we switched, but that's who we use now. It's Texas Pride Lending.
okay?
They're not cheap.
Yeah, I heard some prices from anywhere from $1,500 to $3,000. So
Ooh, I've not heard that. So we used to pay about $750, or the borrowers have always paid it.
right,
But some of the borrowers get frustrated, right? Because they've got added fees. Like, most lenders aren't charging points. We're charging points. I'm sorry, we're charging points. They're getting RMLO fees that are expensive. Some of the stuff that we require for escrows. So the third party escrow company, there's a monthly fee and there's a setup fee. It's not much, it's like $100 some, but it's a lot. It's a lot. And so RMLO fees used to be about $750, but they've doubled the price.
okay. Yeah, I'm gonna start working on that loan doc sheet,
Mm-hmm.
but I may just need another set of eyes to make sure I'm filling it out properly.
Yeah, absolutely. Yeah, and just do your best. And if for some reason you did miss something, like typically the attorney is going to say, "Hey, what about this?"
Okay,
But send it to us. Absolutely, Jade. I mean, that's all. She's working on these things all the time.
okay. And then do you have an attorney that you would recommend for this process?
I mean, you're welcome to use our attorney. Although he did tell me he's retiring soon. But any decent title company fee attorney, you can use their attorney if they're experienced in owner financing. If not, just hit me up and I'll send you our attorney,
Okay.
which is in the members area. Like when you log in.
Yeah, I've talked to him before.
Yeah.
But I remember you mentioned that he's going to be retiring pretty soon, so I'm not sure if there was just another
Don't
recommendation.
tell him I said that. I wasn't supposed to repeat that. I forgot.
Right.
So I'm gonna tell you that.
Right. But yeah, I mean this helps out a lot, and so I'm going to get through this kind of first phase of the agreement in terms, paperwork wise, and get that going.
Yeah. Yeah. And we've only had, man, I don't think we've ever had anyone get denied in the RMLO process. We did have once I know of where the RMLO is like, this person's not going to qualify. So I don't know how that process works. I'll be honest, fully. I know they review financials, they review the price of the home, things like that. But we've been called by the RMLO before, and they're like, this person's kind of iffy. Do you want them to pass or not? Like, they've kind of put the ball in our court. So probably a little shadiness going on there. Joe, you had a question?
I did. So what about a scenario where, we buy the property with hard money.
Mm-hmm.
We sell it with owner finance. but we've got to pay off the hard money lender.
Yeah.
So we convert it to conventional.
Well, that's the part where I said this area over here
Yeah.
that it can get a little sticky. Okay.
Right.
So if you've got, and this is a great question. So you've got, whether it be a hard money loan or you've got a private lender loan, what have you, you've got debt on the property. And what we used to do, it would be hard if it's a hard money loan, but you could do wrap mortgages. You can do the scary thing with wraps was like people were doing them without even the lender knowing. Okay. So you have to figure that out. Basically, you have to figure out that financing. This is why what all of you guys are doing, everyone in this group is like, you're focusing on also raising money. You have, like, in today's day and age, like, you have to be able to raise money, because what we would do, Joe, is, let's say, for example, that we're in a flip deal. I don't even think about it, honestly, because it's like done it so many times, and it's the confidence. And that's where you guys are building to. So I can be in a private money loan. We get an owner finance offer that we want to accept. We're just going to accept it. We're not even going to ask the private lender. Okay. If accepting this contract makes sense for us, that's what we're going to do. Then we're going to go to the lender, phone, email, text, what have you, reach out to the lender and say, hey, here's what's going on, is we're selling this property. They'll say, oh, congrats. I'm like, yeah, it's an owner finance contract. Oh, what does that mean? It just depends on what their knowledge is of it. And we'll explain to them, hey, this is what we're doing. We bought $100,000 and we're selling the property for, 130, or we're going to have a note for 130, whatever it is. And I wanted to see if you'd be open to restructuring your loan to keep your money invested, without, going back on the sidelines. So I might position it that way. And then if they're interested in that, okay, tell me more. Okay, great. So I'll go into, answering questions, but really it's a pretty compelling argument for them, meaning that I can make a pretty compelling argument on how their loan is even more secured with this structure than with the traditional structure. And what that basically means is they have added levels of security. Statistically, one of the riskiest loans in real estate is for a lender to loan to a vacant investment property, which is what we do. It's like statistically true, versus loaning money to a homeowner who lives in the home, who also put 10 to 20% or more down on the property. Right. So that's a safe loan, but there's insulation there, meaning, so now we've got an owner finance borrower. We've got, I'll just say like me or you as the borrower here. And then we've got a private lender. So let's say that money's going up. That 100,000 goes to us. We have a note for 130,000. Well, if the owner finance borrower defaults, I owe what? 100,000. That property's worth 130,000. So I wouldn't stop paying my lender anyways, just for ethical reasons, no matter what. I've never not paid them. So I let them know that. But if they did default, and this has happened to me, I'm not going to stop paying you. One, it's because it's not my character. But number two, it doesn't even make financial sense for me to not pay you on a property that's worth $130,000 or more. I've got equity and I can go do the same thing over again.
Right.
So it doesn't even make sense. Okay. And then let's just say that I do. Let's just say that I do default. Right. So now it would take two people defaulting on you, which is much less unlikely. But guess what you can do? Go take the property back, sell it, and do all those things. So there is added layer of security there.
Right. So, but you're convincing or giving your private lender an opportunity to change it over from a short-term loan to a more longer-term loan.
Yes.
Right.
And yeah. And that is, if it's a hard money lender like a company, it's just not going to happen.
Right.
Right.
Yeah.
So it's going to be a no. So this
Yeah.
is why you need to go to a private lender route. And even if it's for a year, okay. I mean, it doesn't need to be 5, 10, or 15 years. We do have some lenders who've loaned that long, but it's rare. So it can be a short term. What we like to do, if it's a private lender, we like to set it up as a 5-year balloon. Okay. We want to lock in at least 5 years with the balloon. So that gives us way more than enough time to restructure the loan.
Did you say that you have a bank that you use sometimes?
I have a lender that I use.
Yeah. Okay.
I have a lender that I use.
Gotcha.
Yeah. I have a lender that I use. It's not like they get money for like, it's a little bit complicated, but insurance type of stuff, not a ton. But they are looking for loans like that are in the 20-year range. So that's where we go. There's others out there too. That's who my relationships with.
Okay. Because I had done a couple owner finance years and years ago, and I just got a conventional loan when I bought the property, and then I sold it contract for deed.
Mm-hmm.
But yeah, I mean, back then, 20 something years ago, no one really even talked to the lender, the conventional loan lender, the bank or whomever it was.
Yeah.
But I made sure that I got the monthly payment from the seller, or I'm sorry, the buyer, and I made sure that I paid the bank.
Yeah.
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 But
obviously, there's
bad
some
players out there that don't
yeah, but that's what you have to do though, is you focus on the two things that investors should always be doing, right? Always looking for deals, always looking for dollars.
Yeah.
That's it. Devon, did you have a question?
Yes, sir. So kind of going back on Joe's question, there is companies that are private money lender, not private money, owner finance companies, correct?
Mm-hmm. Yep.
Like if on his scenario, if you do a hard money loan and the buyer wants to do owner finance, and you just don't have the means to do the owner finance, you can reach out to one of those companies just so you can close on the deal, correct?
You can, okay, but some of those companies, they're note buying companies, okay? So some of those companies are going to want to buy the note, and they're going to want to discount that note, okay? So you really don't want to do that. The times I've looked to sell notes is I was going to sell them to lenders and said, hey, this note's 10%, 10.99, you can get a 10%, 11% yield on it. So you got to be careful of those companies. That's exactly what they want to do.
So then the other question that I had was, you mentioned the balloon. You can do a balloon, which is the same thing as an ARM, correct?
No, an ARM is adjustable rate mortgage, so the interest rate changes. Okay.
So I know last time you mentioned that in a situation where we're in now, that we don't know how interest rates are going to be in the near future, we can actually do an ARM and say, hey, based on interest rates, we can say up, down, two down, whatever. We can play with the interest rate, correct?
You can play, yes. You can do adjustable rate mortgages to a borrower. Okay, this is a person this is their homestead. Okay, this is their personal home, their personal mortgage. You cannot do a balloon on them. Okay, you cannot do a balloon. We can do a balloon with our lenders because we're investors. They can balloon on us, but we can't balloon on a borrower. So it's going to have to be a fully amortized loan. It can be adjustable rate mortgage to kind of pressure them out to refinance or pay it off as that rate starts going up. You can do that.
Okay. That owner finance calculator was still applied the same way for an arm, correct?
You're just going to have to put those details in there. Yep, absolutely. So it's a little more going to be a little more complicated like that. You're going to have to tweak a little bit, but you can do that. And heck, nowadays it would probably just, you can plug that stuff into Chat GPT and it's going to be able to project that out for you if you give it the right data and prompts.
So, and the last question, this circle owner finance process that we have here, we're going to have access to this to include that owner finance calculator, correct?
Yeah, y'all have all that. Mm-hmm.
Okay.
Yeah.
This is awesome, by the way. Thank you.
Yeah, I need to make sure of the updated one because we did make a couple tweaks. Make a note. This area. Yeah. Yeah, they're in there, but I'll make sure you got the updated one. Oh geez, there was something I was gonna say. I was gonna say, it'll come back to me in a minute. Oh, so here's the thing, guys. Like, there is a little complicated piece, right? What we just talked about, what Joe brought up, is figuring out that financing piece, so that you can confidently go sell with owner financing and know, like, I got it. What are private lenders attracted to? You know, good deals and trustworthy people. Well, these are, if you're doing these the right way, these are really good deals and you're trustworthy people. So that money is going to come to you. And now you guys, you're getting equipped. Okay. You're getting equipped with books. You're getting equipped like with this kind of stuff. This is the next phase. As soon as y'all's books are done, I know Frazy's not doing this, but it's okay. You guys, like, we're going to talk about this real quick. Like, so this magazine, this is what, 7 pages. So my wife has started working again. She's working part-time, and she took some of these. She's like, oh, she saw it sitting out. She was like, I could take these. She works art of skin. She's doing so good. She's like doing so good. Anyways, so she's doing part-time and she's working at this place and they do like skin services and all this kind of stuff. Set these out this weekend, and she was like, you need to talk to this guy because he was sitting there, he came with his wife, and I was talking to him, and so he was like, how do I meet this guy? I want to talk to him. And this is like a high net worth kind of guy. And she's like, she told him, that's my husband. He's like, I want to meet him. How can I talk to him? I'm like, I want to meet him because of this, right? So this is going to be like, once you get your materials out there, you got to get them out there. But once you get them out there, it's like shooting fish in a barrel. The materials will do the selling for you. They will totally do the selling for you. This thing, I know, getting onto this call with this guy who I've not had a call with him yet. I'm like, he's already sold. I'm basically, whenever that call is had, I'm just going to be an order taker. There's a big difference in selling versus like, okay, let me take your order. You want cheese with that? Yeah, that's how it becomes. And so that's the piece, that's the missing piece that most investors don't have in our marketplace when it comes to owner financing. That's why they don't do it. And most of them are not going to go and put in the work that you guys are putting in and do what is required to fix this problem. It is a massive, like they've got a ship, it's a big leak in their ship, that's why it will sink. So you're not going to have a big leak in your ship. Like you're not going to have that. Like, nope, we're going to keep moving right ahead, full steam ahead with this owner finance and bring it to me. I love it because it's cash today and it's cash tomorrow, and it could be cash 5 or 10 or 15 years from now. Okay.